Sone ki chamak, the glitter of gold. Well, everybody is bedazzled with what is happening to gold prices. Well, Indians, they love to own more gold and love to know more about gold. And some very basic questions which we would be discussing, debating and ideating. Why has gold gone up? Where are gold prices headed? What is the best way to park your savings in gold? Gold versus silver. Has diamond lost its luster? And what will make you rich? Nifty or gold? Let's discuss all that and much more. And today we would be discussing that with, well, we've got a very interesting set of, guests. We've got Vikram. He represents, of course, Nippon Mutual Fund. He will tell us that where gold is headed and why gold is headed higher. From Ashish ji, we'll really talk about the footfalls in terms of what is happening at a gold jewelry store. And with Satyam, we'll try and understand that what the view of a jeweler is in terms of Sone ki chain or Sone ka sikka. So I'll start with you. First is why gold prices have gone higher. Gold is supposed to be a hedge. Right. They say gold does well when there is uncertainty in the world. They say gold does well when there is inflation in the world. They say gold does well when there is war in the world. None of the following is at play. Yet gold prices have just gone through the roof.
See, every gold bull run has different factors, creating that bull tailwind. Now, I won't go too much far because of paucity of time, but if you look at past 10 years, the bull run pre-COVID was primarily driven by ETF flows because investors certainly caught the fancy that ETF is a very, very, superior way of holding gold. And from nothing, the global AUM went to some 2,000 tons. So you can imagine the additional flows which came into ETF drove the bull run prior to COVID. Obviously, during COVID, it was a hedge. Anybody and everybody who could lay their hands on gold was buying. Post-COVID, the narrative changed completely. It was the central banks which were dominating the bullion market, gold market. We saw some spurt in central bank buying in 2017 and 18 also, led by Chinese and Russian central banks. But I believe it got punctuated during the COVID. Post-COVID, they have been massive buyers. Just to give you an example, on an average, long-term 50-year average, they buy roughly about 400, 500 tons per annum. But past 2-3 years, they have averaged more than 1,000 tons. So that's the kind of quantum they have added in terms of flow. Also, in terms of their portfolio, if you look at a central bank, an average central bank portfolio, 25, 30 years back, it used to have roughly about 75, 80% as US treasuries and rest including gold and other currencies. But today in their portfolio, the US treasury holdings have gone below 60%. So if this trend continues, then US treasuries or US dollar will become a minority holding of their bank. So it's as far as central banks are concerned, it is nothing but it is you may call it de-dollarization, you may call it diversification away from dollar, but this is what is happening and the momentum is still with them. Particularly if you talk about 2025, gold started with a bang and the main driver now so far in the first 2-3 months is the investment demand through the gold ETFs, especially in North America, which has come back after 4-5 years. So I think that various factors, and obviously investors right now are buying because of so much of geopolitical, geofinancial, uncertainty. That's why they are buying. So I think we'll have to wait and see that what factors play out in this year. But definitely investment demand, which was dormant for the past 5 years, just to give you an idea, the ETF holdings in the past 5 years have come down by 30-35%. And so we have seen that ETF flows coming back. Now, how much of these ETF flows will take up the slack from the physical market? Because obviously at higher prices, you'll see some demand destruction. It remains to be seen. But again, if it's a 4-cylinder car, 3 cylinders are still firing for gold.
So first reason why gold has gone up is because central bankers are buying it. All central bankers have what could be called as surplus. And that surplus historically used to go into US Treasury, the safest of the safest. Now it is going into gold. As a result, like Vikram said, that they would buy about 500 tons a year. That's
400 to 500 tons.
That's gone to about $1,000. So global central bankers are buying physical gold. Ashish, at your store, are you now getting customers who first wanted to buy gold jewelry but now they want to buy physical gold. It could be a chain, it could be a coin, like we say in Hindi, guinea. Are you getting a sense that this entire uptick in gold is leading to physical demand of gold also?
So whenever there is any spike or sudden drop in gold, customers react in a very peculiar way. When the rates were around 40,000-50,000, when there was a spike, people used to rush in to sell.
Okay.
They wanted to sell and make the money. But after 50,000, we have not seen that urge to sell. They have realized that this is not going to stop. So everyone is accumulating more gold after 60,000, and the proportion of old gold sale in the jewelry sales that we have used to be earlier 30% historically. But since this boom has started, it has gone many a times up to 45%. So every 100 grams of new ornaments that people are buying, 40-45% of old gold is being sold.
What does that mean? Can you tell for us? I mean, can you break it up for what does that mean in terms of
That means if I'm buying 100 grams a necklace, I will bring my old gold from my home, about 40 grams of old gold, and balance 60 grams I will pay cash.
Is that good news for you as a jeweler, or is that bad news?
It doesn't make much of a difference because we buy old gold as per the market rates. So that's not an issue. But that when the rates go up, this proportion changes. And when the prices are consistently going up, yes, the investment demand for the sikka, as you said, that goes up slightly by a few percentage points. It's not like a huge thing. Generally, it is 5 to 7% has been the bullion demand out of over 100% that a retailer sells. But it goes up to even 12, in sometimes 15%. So that is the psychology change that we have seen.
What is your big observation as a jeweler? What have you seen changing in terms of a customer appetite for gold?
See, previously the thing is that for jewelry, the heavyweight jewelry used to be working a lot. Jewelry from 250 to 350 grams, 400 grams for a wedding jewelry. Now the trend has come as in lightweight jewelry because the gold rates increase. Lightweight jewelry has started moving. When the customer from the rural areas in 2-tier, 3-tier city, they come in, it happens so that they come with a kitty of 2 lakhs, 3 lakhs, 5 lakhs. They don't come with a grammage. I have to buy about 20 grams of gold or 30 grams of gold. It is mostly to see that we want to buy 5 lakh rupees ka lena hai, 3 lakh rupees ka lena hai. So in that terms, the weight range has reduced. And in the coming times also the retail showrooms as a manufacturer, wholesaler for gold jewelry, we are seeing the retailers also shifting from 22 carat to 18 carat. When we come to gold coins or gold bars, it has increased by 2 to 3%, but 80% in any shop, in any jewelry shop, you will see 80% gold selling, 11% diamond selling, another 9% gold, jadau, kundan or other elements selling. So still the end consumer, in spite of the rate hike, we can see that in the last 3 years, there has been an import or sale of jewelry of about 750 to 800 tons. I can say that in the value terms, it has been about 3.5 lakhs to 4 lakh crores a year import, and with the same amount of tonnage coming in, right now it has increased to 6.3 lakhs to 6.8 lakhs crores. So I think in India, the lust for gold or the need for gold is just increasing as per the value terms.
A very basic question. What we look at the gold rates on a daily basis, that is for 10 grams, 24 carat.
Yes.
18 carat and 22 carat. Do they move in tandem with each other?
Yes.
Or there is a difference?
See, if there is the gold rate is basically 90,000, you multiply by that by 24 carat, multiply by 75%, and that the rate will come to.
So it is not the difference between 22 and 18 is going to be differentiated.
Same,
it is mathematically.
Okay. It's mathematically done. So I think it should not be a problem in calculating. There is no further discount.
As long as you're buying gold, doesn't matter.
No,
whether it is 18, 20,
yes,
or 24,
yes,
it is the same proportion.
How much ever gold is cut, it is the same value.
And what is the lowest denomination of gold you get, Ashish ji?
In India, we have currently, BIS has allowed 14 carat is the lowest, and there is a proposal to even get 9 carat jewelry certified by BIS because the prices have gone up. Second advantage of going for a lower caratage jewelries, yes, the price per gram goes down, but because of lower caratage of gold, there is lower gold content, so it is more lightweight.
But bullion is always 24 carat. Bullion
it is always 24 carat, 995 or 999.
If somebody wants to, let's say, make a saving in a lower carat gold, is it possible in India?
So any form of investment in gold is kind of a saving. gold has many faces. It's an investment, it is insurance, it is a saving or an asset or a currency. So people, even at 18 or 22 carat, it is the gold content is part of saving.
My next question to you, Vikram, is where is gold headed? Everyone has data, and depending on which time frame we are looking at, we can talk about periods where gold has outperformed and period where gold has underperformed. So if the starting point is 2025, March 2025, next 3 years, do you think gold can give a CAGR return of 10% plus?
So I think today, as we are hearing, that demand destruction to some extent is definitely a headwind for gold. We can't ignore it because at the end of the day, gold is various things, but it is also a commodity which has to be consumed and bought for the prices to be supported. Also, what happens is that the ETF and the speculative or derivative flows tends to be chunky, whereas the physical demand is spread over, over the year. So typically, the ETF flows and the derivative flows tend to amplify the price moves. So I think some element of that could be in the gold prices. But having said that, the 2-3 big themes which are playing out for gold is that despite gold doing so well in the past 3-4 years, investors are still underweight gold. I mean, you look at the AUM of gold ETFs in India, it is less than 1% of the total AUM.
But Indians have physical gold, so will that be a fair comparison? I may not own gold in AUMs, but I have a lot of physical gold. So Indians are technically not underweight on physical gold per se.
Agreed. But if you take even the typical HNI, ultra HNI portfolio globally also, they are also less than 1%.
So your view is that gold, now there's nothing certain, but according to you, on a scale of 1 to 10, there is a possibility and a probability that gold in 3 years from here can give a CAGR return of double digit.
I would say I won't limit to a number, but I think the 2-3 forces which will play out is that the underweight investors, central banks which will keep on buying. If the US tariff, sort of materialize, the worst case scenario materialize, what it does is it recalibrates the current account deficits of all the countries, either directly or indirectly, which means we may be heading towards even more currency volatility. So it not only becomes an investment, it again becomes a very strong hedge. So there are 3-4 forces playing. The thing is that, as I mentioned, it's a 4-cylinder car. Sometimes 2 would be moving in the other direction. But as long as the 4 are moving in the same direction, gold will remain in some sort of a sweet spot. But obviously, as I always tell investors, that gold is not a momentum play.
Yeah, fair point.
It's a game of patience. But I think as you look at now, all the factors in gold have yet not, positive factors in gold have not yet
gold
retreated.
according to you is headed higher. I mean, अगर आप ये show देख रहे हैं तो सोना बेचिए मत. I mean, if you have physical gold, if you have it on ETF, keep on riding gold. This is not like, what happened to the Indian stock markets in mid and small cap stocks where January or last October, they had reached absurd valuations. So in terms of the dynamics, I think the sense here from Shyam, Ashish ji and from you is that gold has not reached what could be called as a very expensive high benchmark where the underlying demand and valuations cannot be justified.